Hi, everyone. My name is Jessica Myers, and I am the District of Columbia's Student Loan Ombudsman. Our office is part of the Department of Insurance, Securities, and Banking, or DISB, and thanks to support from Mayor Bowser and Commissioner Woods, our office helps resolve complaints and answer inquiries from student loan borrowers. Today, we will be discussing federal student loan default and delinquency. If you have any questions or concerns about your student loans or something you've experienced with your student loans, please reach out to us at dcloanhelp@dc.gov. The end of this presentation will have our contact information as well. You can reach out to us with any questions or concerns you have regarding your student loans or student loan funding. We're here to help. So with that, let's discuss federal student loan default and delinquency. So you may have seen a lot of headlines in the news about student loan repayment and wage garnishment, collections, and default. We understand this can be stressful to see as a student loan borrower. The hope for today's presentation is to break down these terms a little bit more, understand the financial impacts of default and delinquency, and potential options if you are struggling with repayment, delinquency, or default. Let's start by understanding what these terms mean. What is delinquency? What is default? So delinquency is a late payment. Say you have a payment due on January 1. If no payment is submitted, your loan will be past due or delinquent on January 2nd. After 30 days of not submitting a payment, you might incur late fees, which means you'd pay more than if you paid on time. After 90 days or 3 months, this can lead to negative credit reporting. Negative credit reporting is data in your credit report that can negatively impact your credit. So this can have negative downstream effects. It can be harder for you to access housing, a small business loan, credit cards, other types of loans, and in some cases, employment. So to reiterate, that late payment is then reported to the credit reporting agencies after 3 months. If you go 270 days without making a payment or 9 months, your federal student loans may enter default. The consequences of default are severe, and we'll get into what that means in a little bit more detail later. But at a high level, default means that your tax refunds can be seized to offset your outstanding student loans, or your wages can be garnished to pay your student loans, reducing your paycheck. We work with borrowers routinely who have questions about where we are now with student loans and what the market has experienced over the past few years. Let's discuss how we got to this moment. In March 2020, there was a payment pause put into place where no payments were due and interest did not accrue. In October 2023, payments started again. The Department of Education instituted something called an on-ramp period, which essentially was a year period with no negative credit reporting. In October 2024, the on-ramp period expired and the negative credit reporting switch was turned back on. So borrowers started to see negative credit reporting and negative credit hits in Q1 of 2025. Remember, this is what we discussed with late payments that can impact your credit score and your ability to obtain housing, credit cards, other types of loans, and employment. In May 2025, the Department of Education began collecting on loans in default. You might have received notices regarding default and potential offsets. Wage garnishment is expected to start again in the summer. So based on what we see in the slide, essentially the period in white had no negative credit reporting, and this expired at the end of the on-ramp in October 2024. Let's now discuss the impacts of delinquency and default. If you're late on your payment, your loan enters a delinquent status, and you might incur late fees after 30 days. You then might have to pay more than you originally thought. You can experience negative credit impacts after 90 days. Again, this can impact your access to housing, employment, or other types of loans. And these late payments can stay in your credit report for up to 7 years after the initial delinquency. What are the consequences of default? You're at risk of default after 270 days of missed payments. There are several consequences of default. For one, acceleration occurs, meaning the entire unpaid balance of your loan becomes immediately due. You aren't eligible for certain payment plans, forgiveness programs, deferment, or forbearance. You can't borrow more federal funds. Your wages can be garnished up to 15%. Your tax refunds can be offset, meaning reduced. And then additionally, you can experience those negative credit impacts that we discussed with delinquency. As a borrower, here's the timeline to know. Delinquency and default are all to your timeliness with your payment due date. After 1 day, your loan is considered delinquent or past due. If you don't submit a payment in 30 days, that's when a late fee may incur. After 90 days, you can experience negative credit reporting. After 270 days, the loan may enter default, and that begins the cascade of default impacts that we discussed, such as potential tax return offsets and wage garnishment. To check if you're a delinquent, you can visit your servicer's website. Past due amounts are typically notated in red font. You can also call your servicer. You can check for any defaults or delinquencies on your credit report. You can access your credit report at annualcreditreport.com. You can access a free report on this website on a weekly basis. I also want to take a step back. We mentioned a servicer. What is a servicer and how can you find out who your servicer is? So a servicer, they're the entity that's typically handling the day-to-day of your student loans, like your payments or billing. If you're wondering who your servicer is, you can log into studentaid.gov. You'll see your name in the upper right-hand corner next to an icon of a person. Hover over your name and a drop-down will come up and it'll say Dashboard. Click Dashboard and then scroll down to a section called My Loan Servicer. If you have any questions or concerns with that, you can also call the Federal Student Aid Information Center at the number listed here, 1-800-433-3243. There are also a few options to check if your loan is in default. You can log into studentaid.gov. You'll see your name in the upper right-hand corner next to an icon of a person. Hover over your name, which will lead to a drop-down where it says Dashboard. Click Dashboard. If your loans are in default, you'll see a red banner at the top of your screen, like you see pictured here, and it'll tell you the number of loans that are in default. Here's another way to check if your loans are in default. You can log into studentaid.gov. You'll see your name in the upper right-hand corner next to an icon of a person. Hover over your name, which will lead to a drop-down where it says My Aid on the top. Click on My Aid. Scroll down to Loan Breakdown, and then click View Details. You'll see a list of your loans. Any loans in default will be outlined in red with a red default notice. Under loan status, it will say default. You can see that pictured here on the image where the arrow is. What are your options if your loans are in a delinquent status? So if you're able to make a payment as soon as possible, you can also enroll in an income-driven repayment or IDR plan. These are repayment plans that essentially tie the amount you pay on a monthly basis to your income, family size, and tax filing status. For some borrowers, this payment might even be $0. You can enroll and explore income-driven repayment options on studentaid.gov. You can also call your servicer and request something called a retroactive forbearance. Finally, you can consider deferment or forbearance options. I want to take a moment to emphasize that deferment and forbearance aren't typically long-term repayment solutions. So for example, there's a limited amount of time you can remain in some forbearances. We recommend exploring income-driven repayment options, and if those aren't suitable, then exploring deferment and forbearance. What are your options if your loans are in default? So generally you can explore loan consolidation and loan rehabilitation. With consolidation, that means you'll pay off the defaulted loan and you'll have a new direct consolidation loan that is current. You can also rehabilitate your loan. This means you agree to a loan rehabilitation agreement in writing. And then over a period of 10 consecutive months, you pay 9 reasonable monthly payments on time and in full. It is really important to emphasize that you must enter a written rehabilitation agreement to get your loans out of default. You need to enter into a written agreement with your loan holder to rehabilitate your defaulted loans. Without a written agreement, payments may not count towards rehabilitation. There are pros and cons to consolidation compared to rehabilitation. For example, whether a default stays on your credit report impacts the option you choose. The length of time for each option differs. Your default history, including if you have rehabilitated your loan before, and consolidation history may also impact what options are available to you. If you have questions, visit studentaid.gov or contact our office. You have rights and protections available to you in navigating student loans, including federal student loan default and delinquency. For wage garnishment, the government can garnish up to 15% of your disposable income, but you have to be left with at least $217.50 per week. With wage garnishment and tax refund offsets, you'll typically receive a notice that wage garnishment or offsets are starting soon. For wage garnishment, you'll typically get this notice 30 days before garnishment begins. And with offsets, you'll typically get a notice 65 days before offsets begin. You can request a hearing within 30 days of your garnishment notice and 65 days of the offset notice. As a student loan borrower, you have a right to timely, accurate, and complete information about your loans. For example, you have the right to know if you are delinquent or in default and what options are available to you. You have rights related to debt collection. Debt collectors cannot harass, they cannot intimidate, and they can't use abusive language. Debt collectors can't contact you before 8 a.m. or after 9 p.m. unless you agree to it. Debt collectors can't contact you by email or text if you ask them to stop. Debt collectors can't call you more than 77 times within a 7-day period or within 7 days after talking to you about the debt. If you have concerns about anything regarding your protections and practices you experience with your student loans, please do reach out to us. We are here to help you. If you're a district resident or district government employee, please contact us. We are happy to help with any questions, concerns, or inquiries that you might have. You can call this number, 202-727-8000, or email us at dcloanhelp@dc.gov. We understand this is a stressful time. There is no such thing as a silly question. Even if it's trying to understand what's going on with your loans, we're here to help you through that process. Thank you so much for joining us today.